Hey traders, welcome back to the channel. This is my second YouTube video. In the first one, I talked about my trading philosophy, and today I'm going to show you a risk management tool for the index future trading. I think one of the biggest challenge for a lot of future traders is that they don't know what their account balance is gonna look like if the price keeps dropping. Like, am I gonna get liquidated at that price point, or I'm gonna be okay? So they're not sure if they can still hold their positions to a certain price point with enough money for the margin. And that uncertainty creates a lot of anxiety, which lead to the bad trading life. So today, we're going to design a risk management tool with Excel by assigning each price scenario with a probability, and then calculate exact how many contracts we can safely trade for each level. So here is what we're going to cover today. First, we're going to walk through the Excel risk calculator that I use. We'll go through every formula, every input, and how to set up your own parameters. Secondly, I'm going to show you how to find your optimal betting size by using the famous Cowley criterion, so you know how much to bet based on the math. And finally, I will show you something even better, a tool that does all of this automatically, so you don't even need Excel. Alright, before we get into the calculator, let's make sure we're all on the same page. MES stands for the macro E-mini S&P 500, and each contract represents a fraction of the S&P 500 index and syncs with the SPY ETF. We use SPY's price to calculate our risk for the MES contracts because the pricing is more consistent.
This is where scenario-based risk management comes in. Instead of just saying I can trade 10 contracts, we're saying, based on these 7 possible scenarios with their probabilities, here's how many contracts I can safely trade without facing liquidation later. Let's go ahead and open up the Excel file and I'll show you exactly how this works.
Alright, here's a risk management file. Let's start with the input parameters. So these are the values you will customize based on your trading accounts and strategy. It doesn't have to be MES, it could be ES, NQ, or mini NQ. It will work the same way. So the first one is your trading balance, your trading capital. In my example, I'm using a $200,000, and this is the amount of your cash that you have available for the trading. The second, this is the overnight margin. This is the margin requirement to hold the position overnight. I set this to 2,500. You can get this info from your broker, and this gets subtracted from your initial. So for example, you can search your broker's name and future margin rates and search your MES or ES, whatever you're trading. It will show you the overnight margin for long and short. So double check those numbers once in a while because they might change without noticing you. Okay. So the next one is buy SPY great space. This is set up as 5. This might be a little bit confused. So this is just assumption for a lot of traders. Like for example, they have a contract already, and when the price drops, they might add another contract to lower their average holding cost without getting a chance to sell for a profit. For example, the SPY price is 680 right now, and your next entry level will be 675 and 670. I mean, it doesn't mean that you have to trade like this, but it's just like a close to real life scenario to help our calculation. The next one is a SPY market price right now, and I set up to 680. You can change it up for later use. And the next one is SPY to MES point ratio. I set up to 10, which just means every point that SPY changed, the SPS or ES, MES gonna change for 10. And the next one is each point dollar amount for the MES contract, which is $5. I think it's the same for the NQ or MNQ. The next one is the SIP threshold. It's set up as 50%. This is like a safety factor. This threshold is to be conservative. If this is 100%, it's like, oh, I'm gonna go all in. I'm 100% sure this is it. So it's set to 50%. We don't want to go beyond that. Finally, the positions. This is your current open positions. Start with 0 if you don't have any open positions. All right, now we get to set out our long support scenarios. So the support level of the price point we expect the market gonna respect and bounce back, and we can put in a long position for a profit. So I have like 7 scenarios list here for the each of those. I have a price point, and you can make a note for the reason that you believe why you're gonna bounce back. So in my calculator, I have 7 scenarios, and you can adjust it to like 5 or 4 or maybe 10 if you like, but make sure for each scenario you have probability, and make sure it adds up to 100. Now let's look at the calculations. First, we have some positions. This tells us how many actual positions you are likely to add to your account when it reaches to the next support level. So let's say right now the price is 680. So when the price dropped to 670, based on our buy grade, you will add to another 2 position to your account. So just 680, which is current price, minus 670 is your next support level, and divided by 5. So you started with your current 0 position, and the price drop, drop 50 points. You feel like, you buy a long, probably gonna bounce back. You don't have to. Just like, a simple calculation for the later use. So when it drop to 670, you'll have 2 positions, which is 2 here. And same thing if the price drop to 652, and you keep buying for every 5 points of SPI drop, and you didn't have any chance to sell it for a profit, and you will have 6 positions for the long position. The same thing, you just drag it down, and if it drop all the way here, which is I assume going to be a worst scenario, which is like not very likely, you'll have like 30 positions. That's saying you don't have any chance to sell those positions for profit, and you just keep buying, keep buying. And the next one is total loss. This is how much money you will lose, assuming that you have bad luck and your holding goes down and you can't take any profit. So I like to prepare for the worst when it comes to the risk management. Again, it doesn't mean how to trade this way, but you want to prepare for the worst because anything could happen, and you might just set up limit buy there and you accidentally get that position you don't want. So this is how you calculate it. So there are 2 parts of the total loss. First part is from the position that you already have, times the points difference between market and support level, and then multiplies the dollar amount per point. And second part is from the positions you add along the drop, and that use the midpoint of the price difference for the average, and then multiply the dollar amount per point. The next one is adjusted balance, is when the price dropped to that chart level, what's your balance gonna be? So when you start with 0 position, if the price drops here, this is going to be your total balance at that price scenario. And the next one is your holding cost. Since you buying one at the SPY level 675 and buy another one at 670, so you have two positions, and based on the overnight margin cost, so two position you'll need $5,000 to hold that for the contract. And next one is actual room, which is adjusted balance minus the holding cost, which is how many actual money you can play with, assuming you put your holding money aside, and that's the actual money you have for the actual room. Next one is loss per contract. This calculates how much money you lose per contract if the price reaches that support level. So 500 means each contract will lose $500 if the SPY price drop from 680 to 670. That's 10 points, which is 100 points for the SPX, which is $500. And the next one is max hand. This is the maximum number of the contracts you can trade for this scenario. And this is how it calculated, which means at this price point, if you're 100% sure the lowest will be this one, and this is the maximum amount of money, amount of contract you can hold, which is drop below this price, you will get liquidated. So this is how you calculate it. You use your holding margin minus this is negative, you minus negative 500, so you get 3,000. So you lose 500 and you still need 2,500 to hold it and get divided by your initial balance. That's and also you also want to round it down. So and that's the maximum amount of contract you can have at this price level. So you got 66 here, and if you 100%, this is the bottom, and the maximum amount of contract you can hold at this price level will be 51. And same if you believe, let's say you think 600 might be the bottom, on the maximum contract you can have at this price point without getting liquidated at this price point is 30. It's 30 contract for MES. And next one is probability weighted columns. So we're not 100% sure this is going to be the bottom, because so we have the probability for each scenario based on how much we believe each price point, each support will be the bottom. So we use the max hands times the probability. We got the probability weighted hands in this column. So 66 times 35% of chance is 23, which means only have 23 hands at this price point, between 680 to 670. I mean, that's the maximum you want to have. So this gives us a conservative estimate of how many contracts we can trade for each scenario, weighted based on the probability and safety. So you want to be a little bit conservative, but not too extreme, because that's gonna hurt your profitability. So this is just gonna let you know ahead of time what's gonna happen to your account for the worst scenario, so you can prepare it. And you also want to adjust all those numbers, keep those update when the price change. For example, if the price dropped to 680, from 680 to 660, you also want to adjust all those support level to lower than 660 as well. And next one, I add another layer of the safety by multiply your safety threshold to the probability, because this is your probability times the maximum of the contract you want to hold. And add another 50%, which is half of the contract, just give you a extra layer of protection. So for each support level, you have this number for the maximum contract you want to hold, and you add them up for each level. You get your total amount of bullets you have in your hands. I call it playable hand, or sometimes you can call it bullets or whatever you want to call it, ammo maybe. That's for the long side, and for the short side, it's the same thing. You set up for the each scenario for the resist and give it a probability, and the rest is just the same thing, and use negative because you're shorting it, and you get your maximum playable hands, at that price point. So maximum you can play like 16. And when you play some, let's say you add two positions, and they automatically subtract from your playable hands. And you can also notice that the actual room became to negative, means if you hold two positions here and the price keep dropping down all the way, and just keep buying and buying for every 50 points of SPY drops, and you don't have any chance to sell any contracts for profit, and your actual room becomes negative, that's the time you might facing liquidation. You probably can only hold, like, instead of 30, you probably only hold 27. So you have to get liquidated 3 position when the price drop all the way from here to here, and you just keep buying without any sell. And now I'm gonna show you an actual thing called the Criterion, which is the formula that the most quant company use it for calculate their betting size. I'm not gonna talk exactly how it works because you can check on like Wikipedia or other YouTube. So what this does is, when you know your winning rate and your win-lose ratio, you can use a mathematical formula to calculate how much you should bet for the maximum profit. So I just set this for win rate 60%, and the win-lose ratio is 1.5. And this works very well because we already know our playable hand. So this is instead of using this number, we use our playable hand. And you can use half Kelly for the betting size for extra safe. I mean, extra safe, since we already get threshold and probability, and use half Kelly to to times your playable hands. So each time we want to bet, you bet like 3 position, on the MES when you have like $200,000 in your bank account to play. So that's it. I mean, I'll show you the Excel method, which works great. But what if I tell you there's an easier way? So let me show you this web version of the risk calculator that you can use. This does everything that Excel does, but it's faster, it's easier to use, and automatically save your settings. Let's say if you don't have Excel spreadsheet with you, you can just use this. This will be under my website, under tool and the risk calculator. And I'll drop the link below, and it's free for you. You can use anytime you want. If this video helped you, please hit the like button and subscribe to the channel. I put out new trading tools and tutorials regularly, and I'd love to have you along for the journey. The next video, I'm gonna talk about the trading strategy, and you don't want to miss that one. If you got any questions, drop them in the comments below. I read every comment and I'll do my best to help you out. Thanks for watching, and remember, manage your risk or your risk can manage you.